Stackers stop and really look at the charts. Those red numbers aren't just spot prices, they are psychological pressure. They are scripted to trigger fear, FUD, and total urgency all at the same time. I know the exact gut check you're feeling, that chest tightness, the voice asking if you blew it, wondering if you should liquidate the stack immediately before this tamp gets even uglier. Only 48 hours ago, the metal was kissing all-time highs. The vibe was pure euphoria. Triple-digit fiat prices weren't a fantasy. They were expected. Now it's Monday morning, DECA 29th, and silver sits at $75. The chart looks wrecked. Momentum is dead. And the MSM narrative is already spinning. The bubble has popped. The silver squeeze is finished. Dump the stack before the crash. Stop, breathe, listen very carefully. Nothing fundamental changed. No new supply hit the market this weekend. No mine found a hidden mountain of silver. No policies flipped. The physical reality is exactly the same as 2 days back. The only thing different is the spot price on that screen. What you are seeing isn't a collapse. It is a bankster trap. The final trading week of the year is not a normal market. Liquidity dries up. Volume thins out. The senior pros are gone. What remains is an empty arena run by algos and junior desks reacting to low volume noise. Here, prices don't move because fundamentals shift. They move because there is no resistance. One shove can look like a crash. A temporary air pocket can feel like the end of the bull run. That illusion exists for one reason: to test your diamond hands. This is where markets transfer real wealth, not through smarts, but through emotion. If you mistake the tamp for reality, you hand your ounces to a whale who knows the difference. This specific week has a name. Understanding it may change how you see everything that follows. Type 1 to continue reading Chapter 2. Type 2 to quit right here. If this shifted your view of the chart, subscribe to the channel and comment 1 below. Now that you've taken a breath, let's discuss why this drop feels so violent and why it was almost guaranteed to happen now. Markets don't just move on digits, they move on structure, and the structure of this particular week is fundamentally broken. The days between Christmas and New Year's are what professionals refer to as a dead zone. Volume collapses, order books thin out, liquidity evaporates. In a normal week, if someone wants to sell a massive block of silver, layers of buyers are waiting. The transaction gets absorbed, the price barely flinches. It's like tossing a stone into the ocean. But this week isn't the ocean, it is a tiny bathtub. When liquidity disappears, the market becomes fragile. One aggressive sell order doesn't meet resistance, it falls through the empty space. Spot doesn't decline gradually, it drops vertically until it collides with the next technical level, where someone somewhere steps in. That sudden fall looks terrifying on a chart, but it isn't a reflection of value. It's a reflection of absence. And this is where market psychology enters the equation. A sharp red candle doesn't just move price. It sends a signal. Tech systems read it as failure. Momentum traders read it as weakness. Retail investors read it as danger. The market doesn't need bad news when it can manufacture fear through optics alone. Ask yourself a simple question: if silver's fundamentals were truly broken, if the long-term thesis had collapsed, why would this move happen during the lowest volume week of the year? Why not during peak participation, when conviction could be tested honestly? Because this isn't about discovery, it's about exploitation. Thin markets allow small actions to create massive reactions, and massive reactions force emotional decisions. This isn't random volatility, it is predictable behavior in a distorted environment. The chart isn't lying, but it's not telling the whole truth either. You are watching shadows on the wall, not the source of the light. And if you don't understand the structure behind the move, you'll misinterpret noise as signal. Before you react, before you decide anything, you need to understand who really benefits from this confusion and who doesn't. To understand what is really happening, you have to stop thinking like a chart reader and start thinking like a poker player. This move to 75 isn't about silver. It's about you. Specifically, it's about your emotions, your leverage, and your pain threshold. Large institutions know exactly how retail positioning works. They know where late buyers entered 78.79 near the highs. They know how many traders are sitting on margin. They know how many options expire this week, and critically, they know where the stop-loss orders are clustered. Those levels aren't a mystery. They're visible footprints. In a thin market, triggering those stops costs almost nothing. A brief aggressive pushdown is enough to trip a chain reaction. Once price hits those levels, selling becomes automatic. Computers sell, brokers liquidate, traders panic. And suddenly a manufactured drop feeds on itself. Here's the part most miss the selling. You're seeing isn't voluntary, it is forced. It's margin calls, it's stop-loss executions. It's fear doing exactly what it was designed to do. And on the other side of every forced sale is a buyer who wanted your position all along. This is called a liquidity flush. Shake the tree. See what falls out. Weak hands let go, not because they're wrong, but because they're uncomfortable. And discomfort is very expensive in markets. Ask yourself who benefits from silver being cheaper right now. Who would want to accumulate before a known structural change? It's not the small trader staring at a phone screen. It's the entities with time, capital, and patience. This is why these moves always feel personal. They're meant to. Doubt creeps in quietly. Maybe the thesis is wrong. Maybe the shortage isn't real. Maybe I should just protect what's left. That internal chat is the real battlefield. Markets don't punish ignorance. They punish emotional reactions. And moments like this are designed to separate those who react from those who actually observe. If you're still focused only on the New York chart, you're missing the most important signal in the entire market right now. Because while one side of the world is shaken out, the other side is doing something very different. And that is where the story completely changes. While fear dominates one screen, discipline controls another. To see it, you have to stop staring at New York and look east. Because at the exact moment silver is shaken out in the West, it is being pulled in with urgency in Asia. In China, silver isn't a speculative storyline. It's an industrial lifeline. It runs through solar production electronics and energy infrastructure. Buyers there don't care about a red candle on a holiday chart. They care about securing metal-keeping factories running and protecting supply chains. And right now, they're willing to pay a heavy premium to do it. This is where the whole narrative fractures. Western traders are reacting to a $75 paper quote, but Chinese markets trade a different reality, one that signals tightness, not weakness. The gap between these two prices isn't a rounding error. It's wide, stubborn, and increasingly hard to explain away. In a functioning global market, that shouldn't happen. Arbitrage is supposed to erase differences fast. Buy cheap here, sell higher there, and the spread disappears. That mechanism is the glue that keeps global pricing honest. But today that glue is failing, and it's not because traders forgot the math. It is because something is blocking the flow. When arbitrage breaks, it's not a curiosity. It is a huge warning. It tells you the market that actually needs silver is valuing it far more than the market that merely trades it. One price reflects physical necessity. The other reflects thin liquidity derivatives and pure ghost week psychology. Two prices are forming for the same asset. One driven by fear, one driven by need. History is very clear about how this ends. When physical demand refuses to follow paper weakness, the paper price eventually snaps back to reality very hard. One side is shaking out, the other is accumulating, and the gap between those two actions is where the real opportunity hides. Now we need to confront the number that exposes the entire illusion, because once you do the math, the $75 price stops looking scary and starts looking truly absurd. While New York traders stare at a falling chart, the Shanghai market is broadcasting a completely different signal. The front-month silver contract there is trading at a level that, once converted properly, implies a price close to $90 per ounce. Let that settle in. Nearly 90. This isn't a rumor, folks. It's not speculation. It is just arithmetic. Translate the Shanghai futures price into US dollars and troy ounces, and you get a premium of roughly $14 over the rigged Western paper price. In global commodity markets, a spread of that magnitude is truly extraordinary. On a fungible metal, it borders on being quite impossible. Under honest market conditions, this gap would vanish almost instantly. Arbitrage guys buy silver in New York at 75, ship it east, and sell near 90. The profit would be risk-free. The spread would close within hours. The fact that it is not tells you something is deeply wrong or truly revealing. The arbitrage mechanism is simply no longer functioning. And when arbitrage breaks, it's not because opportunity disappeared, it's because access did. Something is preventing real metal and money from flowing freely between these two markets. That blockage is what's creating this distorted picture, and it's also what's creating opportunity for anyone who understands it. Ask yourself which price reflects reality, the one set by thin holiday trading and algos, or the one set by industrial buyers securing metal they actually need. Factories don't buy panic, they buy sheer necessity. This spread isn't signaling the end of a rally, it is signaling stress. It is the market screaming that the paper price is detached from physical truth. And detachment like this doesn't resolve gently. It resolves itself violently. So why is this $14 gap not closed already? Why is there still silver priced at 75 in the West while the East is paying nearly 90? The answer is simple but uncomfortable. The bridge between these two markets is broken. For arbitrage to work, metal and capital must move freely in both directions. That freedom no longer exists. New export licensing rules are about to lock silver inside China, turning what was once a global flow into a one-way valve. You can move metal in, but getting it back out is another matter entirely today. For a Western bank, this creates a nightmare scenario. Ship silver east to capture the higher price, and you risk being paid in local currency you can't easily convert or remove. Worse, if the trade goes wrong, you may never recover the metal. That uncertainty turns what looks like easy profit into unacceptable risk. So the arbitrage desks freeze up. When arbitrage freezes, prices are allowed to drift apart, and that is exactly what we are seeing now. The Western market has effectively become an island. It is dominated by paper contracts, derivatives, and short-term speculation. Prices there respond to sentiment charts and low-volume games. Meanwhile, the Eastern market is anchored in physical demand factories, infrastructure, and long-term planning. This creates two realities. One price reflects fear and thin liquidity. The other reflects necessity and true preparation. History shows how this ends. Paper markets don't dictate value forever. When physical demand tightens and supply can't ever respond, the paper price is forced to adjust, often suddenly and painfully. This divergence isn't weakness. It is pressure building beneath the surface. The wider the gap becomes, the more violent the eventual correction will be. And right now, that pressure is rising, not releasing at all. The question is no longer whether prices reconnect. The question is how fast and at what level when they actually do. At this point, the price action stops being about markets and starts being about psychology. Because if the fundamentals are tightening, if the physical price is screaming higher, why smash silver down to 75 right now? Why do it during the quietest, thinnest week of the year, huh? Because this is the moment fear is cheapest to manufacture now. The days between Christmas and New Year's create a perfect psychological vacuum. Volume is low. Attention is scattered. Retail traders are over-leveraged from chasing the recent highs. Stop-loss orders are stacked tightly below the market. In this environment, a relatively small push can trigger a disproportionate emotional response here. That response is the real objective here. Institutions aren't selling because they believe silver is worth less. They're selling because they want to buy more at your expense. By driving the price down during Ghost Week, they force liquidations. Margin calls fire. Stops get hit. Weak hands are shaken loose now. And who buys what gets dumped? The same entities that caused the move, sadly. This is not a theory, it's a recurring pattern. Markets are most aggressive when participation is lowest because resistance is minimal. A move that would cost billions during normal volume can be executed for a fraction of the price in a holiday vacuum today. This is why the drop feels personal. It attacks confidence, not logic. Doubt creeps in quietly. Maybe the thesis is wrong. Maybe I should just protect myself. That internal dialogue is the battlefield now. But look at the timing. We are days away from a structural shift that tightens supply even further. Do you really believe the smartest capital in the world is panic selling days before that happens? Or are they using this window to accumulate while attention is elsewhere now? This isn't a breakdown. It is a total clearance event. The final shakeout before the rules change now. Now we have to talk about the calendar because timing is the silent force behind everything you're seeing. This isn't some vague outlook for next year or a distant macro theory. This is a hard deadline measured in days, not months, folks. January 1st completely changes the rules. New export licensing requirements turn silver. from a freely traded commodity into a controlled strategic resource. Bureaucracy replaces flow. Permissions replace markets. And in systems like this, delays aren't measured in hours, they're measured in weeks, sometimes longer. For the month of January, effective supply out of China doesn't just slow down, it freezes up. That's why buyers in Asia are acting now. They aren't reacting to price, they're reacting to access. Every factory manager, every procurement desk understands the same reality. Metal secured today is metal guaranteed. Metal not secured may not arrive at all. This is insurance pricing, not speculation today. That urgency is what you are seeing embedded in the Eastern market now. Meanwhile, the West is still playing holiday games, reacting to candles and indicators as if nothing structural is about to change. This disconnect won't survive contact with reality. On January 2nd, desks return, phones ring, inventory sheets get reviewed, and Western buyers discover that the supply they assumed was always available is now gated, delayed, or simply gone today. That is when true price discovery actually begins. The $75 quote exists only because demand is temporarily absent, not because value is. When real buyers re-enter, they won't negotiate with fear. They'll compete with urgency, and urgency doesn't ask for discounts here. This drop isn't the start of something ending. It's the pause before something irreversible begins. The countdown is almost over and the market is about to wake up now. When the market wakes up, it won't ease into awareness. It will lurch. Because the moment Western desks reopen, they will be forced to reconcile two prices that should never have been allowed to drift this far apart. One reflects paper fear, the other reflects pure physical urgency. And that reconciliation won't be very polite. On January 2nd, institutional money comes back online. Portfolio rebalancing begins, procurement managers re-enter, and the first thing they'll notice is the spread. Silver priced cheaply in the West, expensively in the East. In any rational system, that gap is quite intolerable. So buying accelerates now, not because of optimism, but because of necessity. If you're an industrial user and you see metal trading higher overseas while sitting artificially cheap at home, you don't hesitate. You secure supply. You stand for delivery. You drain the cheapest market first now. That's exactly how inventory disappears. As Western vaults thin, the paper price loses its anchor. Contracts that once settled quietly now face delivery pressure. And when delivery pressure meets limited supply, repricing isn't gradual, it's truly explosive. This is why trying to trade this environment is dangerous. Volatility won't respect logic. Swings will be violent. Algorithms will hunt both sides. Anyone attempting to outsmart the move risks being shaken out just as the real repricing begins now. The irony is brutal. The TAMP everyone wanted is here, yet the herd is too fearful to pull the trigger. Meanwhile, smart money whales are doing nothing flashy. They are stacking the shiny quietly, simply letting time do all the hard work. This is how paper illusions die. Not with a slow fade, but with a violent snap back to physical reality. And when that snap hits, the spot price won't wait for your permission. It is going to moon. What feels heavy to hold now is exactly what massive opportunity feels like before it becomes totally obvious. This is where everything comes together, and where grit matters more than hype. After decades of watching markets pump, dump break, and reinvent themselves, one lesson remains constant. The massive gains are never handed to the loudest traders. They are rightfully given to the most disciplined stackers. What you are witnessing now is not chaos. It is a transition, a shift from a paper-driven narrative to a physically constrained reality. The price tamp to 75 was not a verdict on silver's future. It was a test of resolve before the launch, a final attempt to transfer conviction from the weak hands to the true stackers. The lesson here is simple, but uncomfortable. Markets don't reward those who react fastest. They reward those who understand structure, timing, and psychology. When fear is highest and headlines are loudest, the most vital work is internal, staying rational while the whole herd panics. The strategy in moments like this is rarely dramatic. It is patience. It is position sizing that lets you sleep at night. It is refusing to let short-term tamping override long-term reality. You don't need to predict every tick. You need to survive the noise long enough to benefit from the real signal. Silver's story isn't about a single week or a single price. It is about scarcity, industrial demand, and a global system struggling to reconcile paper promises with physical limits. Those forces don't resolve quietly. They surely resolve decisively. If there is one takeaway, it is this: never confuse volatility with risk. Volatility is visible. Risk is structural. And right now, the structural risk isn't owning silver. It is not understanding why the rigged market is trying so hard to scare you out of it. Stay grounded, stay curious, stay truly disciplined. If this analysis helped you see the market more clearly, subscribe to the channel, like this video, and share it with someone who needs perspective right now. And comment one if you're focused on strategy, not panic selling. This is where long-term thinking really begins.